after our discussion, didn't we, that we're just going to dive straight on in and lay out the stalls so that everyone in the audience can kind of see what your investment predictions are for 2026 and beyond, if you wish to take that. And Rajiv, you sat right next to me, so let's kick off with you first. How are you seeing the investment world for next year and beyond?
Well, we invest in private assets, whether it's private debt or private equity, across the globe. And I would rephrase the question. There is, of course, still lack of capital on the planet. You just have to be local wherever you're investing. And if I had to pick two dimensions, what geography and what assets do we invest in, and I see promise in, and would be one, the US will see 3-4% GDP growth, lot of government support over the next 12 months with midterm elections coming, rates going down. So the US as the principal geography, if it's where we are going to put in capital. Of course, we have a presence in Europe and in India, and the Middle East, we'll do that too, but more than half our investments, dollars, are going to go in the US. And the assets are very simple. Of course, you do the regular real estate and so on, but the key themes are the decoupling of the supply chains, which are being controlled by China today. And those supply chains are rare earths, the whole value chain, mining, separation, refining, producing magnets, 95% done by China, critical for US manufacturing. The US needs 100,000 tons of magnets a year. 95%, it produces 3% today. And that's bipartisan. It's going to move to the US. So critical minerals, printed circuit boards, all that decoupling from China supply chain is a great investment. And going in early, finding the right mines, the right magnet companies, the Solvay is a great refiner. That's one. And second, the AI boom, people are focused on data centers and chips and so on. It's actually the picks and shovels that are going to be very interesting the next 3-4 years. As the hundreds of billions of dollars go in, transformers, HVAC equipment, turbines for power plants, etc.
Yes, and we've been discussing that already a lot this morning, as you can imagine, people trying to get the valuation right on those. But Stefan, in terms of the playground, which countries and which assets?
Well, I think to make the panel punchy, I think we should also slightly disagree with each other. So I think what Rajiv outlined, I obviously agree with, but it's definitely a consensus view to be long US and long AI. Let's agree with that. But typically, when you speak to pretty much anyone on the planet and everyone agrees with that long, it's slightly frightening. So allow me to give a perspective on Europe, where we should recognize that this is a year in which European stocks actually outperformed US stocks in local currency. If you look in dollar terms, we're sort of like 15 percentage points ahead. And we think that that story is going to continue because Europe is finally fulfilling sort of like the long recognized potential that we have, and properly implementing reforms, investing. When you look at Germany, release of the debt brake, investments in the infrastructure. So we continue to be very optimistic about Europe.
And Alexander.
Well, I'm sort of in the middle between Stefan and Rajiv. I think that the Chinese tech sector has a lot of mileage still ahead of it. If you look at the Greater Bay Area, what is happening there is quite outstanding. We have modern cities like Shenzhen, where the average age is 30 years, right? And you see big data and AI being really put into work in day-to-day lives across traffic control, across healthcare, across public services. And a couple of maybe data points on the back of that as well. I mean, if you look at data coming from the World Patent Organization, China is now the #1 applicant of patents. And the other one that is also just happened sort of silently over the last few years, China took the number 10 spot on the Global Innovation Index. It actually took the spot from Germany. So there's a lot of innovation happening in that space. And a lot of people are talking about CapEx and AI. I think China is a good example where you have seen CapEx increase year on year, north of 50%, but in comparison to the US companies, it still stands at somewhere between 10 and 20% over the last few years. So capital has not yet been deployed to the extent that it can. So I think there's a lot of road ahead still for that sector.
And you both, all of you really, have raised that long-standing question of how long is that off-ramp from China in terms of manufacturing and all the things that you mentioned here today. Sandro, what are you going to pick for 2026 and beyond?
I'm not going to say something very original coming last. I honestly think we'll continue to have a very positive view on equities because I think everything is supportive in general. And we think that economic growth will surprise on the upside in 26. When it comes to regional allocation, I think a bit out of consensus, we think emerging market will do well. And emerging market also on the back of some dollar weakness, which will help emerging market to do well. And the valuation spread is significant. So the point is that today, my view is that there are not obvious mispricing in the market. And there's a risk that I think, in a way, diversification should be kind of the rule of the game going forward. Because there will be, I think, the way to create value would be to, I would say, portfolio construction and some limited conviction bet, because there's no obvious place where you have mispricing. And I think it's something that we need to keep in mind. Last comment I would make is that I think 26 will be a year of significant volatility as well for a number of structural reasons. So an additional reason to have a properly diversified portfolio. But if I have to take a bet, it's going to be emerging market.
And we were hearing earlier on from Robin from the Man Group saying, yeah, we don't mind volatility, but we want the right type of volatility. And some of the moves we've seen in the market have been caused by some significant macro factors. And on the political front, I'm trying not to say exactly what that is. But there's no doubt there are challenges. And Alexandra, I want to bring you in on this. What do you see as the sort of major challenges? US tariffs were one of those that Robin talked about, literally changing within an hour, I think. How are you navigating those risks and what do you see them being in 2026 that Sandro was alluding to?
So we see very similar themes. If I look back at 25, what were the main three topics? The US dollar, but it's not just the headline US dollar risk. How is the US dollar sort of impacting the overall portfolio of our clients? So that was one. The second topic was gold. Should you add gold to the overall strategic asset allocation? Yes or no? Why are some sovereign institutions adding gold to an extent that hasn't happened before? And I think the third one, which sort of goes back to what Sandro says, is portfolio construction. And especially as you see private markets, growing in allocation overall, having a better understanding about the interplay between public and private markets. If you look at it at the portfolio level, what is my exposure across sector industries? What is my exposure across, investment factors? These are important topics that, we have been discussing with our clients ahead of going into 2026. And then maybe just an additional new concepts are emerging, total portfolio approach. There are some superannuation funds in Australia and New Zealand that have come up with a new approach, how to think about asset allocation. Food for thought for all of us to think about that further as well.
And we're hovering very much at the macro level here and talking about diversification and dislocation in that market. So, Stefan, what are you seeing there as the challenges?
Well, I mean, just like a smart politician, I'm trying to rephrase it and also talk about potential. Because I think next year, asset managers can actually do their job of assessing risk in different asset classes. While 25 was much more about getting geopolitics right. I mean, when you think about the big drivers, for some of the things that Alex has mentioned, like FX, I think tariffs, what happened in early second quarter was kind of driving a lot of momentum in for a couple of months. So while 25 was a year in which both central banks and markets were mostly driven by geopolitical affairs, I think 26 is the year in which you actually need to, also back to Rajiv's point, be quite domestic and regional in your comprehension of market dynamics in order to add value or, create alpha for your clients.
And I guess for that reason, we're seeing allocations that have been talked about, such as aerospace in Europe and defense being the big targeted sectors, right? Rajiv?
Well, defense is in vogue right now, but defense will be, but it'll take time for defense to build out. It doesn't happen overnight. It's not just defense. As I said, the big theme in my mind is decoupling supply chains in critical industries with China. Not for clothes and so on. That doesn't matter. It'll be whatever that goes into defense, people have to focus on. Whatever that goes into data centers. What goes into defense are critical minerals, are all your infrastructure needs, which is, as I said, HVAC, which again requires that. So you cannot make drones without magnets, for example. So, and that has to be decoupled because China has tremendous leverage there, which the West has realized and will in-house all that manufacturing, whatever it takes. And it's bipartisan. It's going to happen whoever is in power.
So Sandro, the passive-active rebalance. So we've seen passive dominate for decades now. Do you think we're finally entering that sort of phase where active managers can actually regain some alpha?
Very difficult to foresee the future, but I think, look, passive will continue to play an important role. Make no mistake, I think it's the pressures on fees and costs for final investor will continue to be a dominant theme. But on the other hand, I think that I see a few reasons why we might see active coming back over the next few years. One is concentration and diversification. Structurally, by investing passively, you have exposure to highly concentrated. If we take the S&P, the MAGs, I think, are 35% of the index today. They were like 12% 10 years ago. And passive is kind of valuation agnostic. So there's a moment in which there will need to be some reconnection with reality. And I think that's, to me, one of the biggest risks in passive. The second element is that in fixed income, I think there's still significant opportunities for active. And there's a structural reason that a significant portion of fixed income investors are what I would call non-economical. Central banks, insurance companies, where they tend to take decisions not the way we take decisions as asset manager. And that, to me, creates opportunities. And there's a third one, which is, I think, of a longer term. We're really living in a world of what I call the fourth transition. Demographics, digital, geopolitics, and demographics. So these are transitions that we're really observing a paradigm shift. And at a moment of disruption, it's probably the best moment for good active investor to make their job. So passive will continue to be a significant element, but I start to see some opportunities for active going forward.
So I can see Stefan nodding away and Alexander there. I'm gonna pose something to you before you dive in, though. Are you all talking your own books there?
Sorry, are you talking about?
I said, are you all talking your own books there, being the asset managers behind?
No, look, I think I'm probably the smallest in terms of ETF compared to my colleague, but it's a key area of growth, and I think it's going to be a very important ingredient. But look, I think as usual, we tend to exaggerate and we go either 100% one way or the other. I think there's room for both. I think you need active and passive. And the line of divide between active and passive is also a bit blurred. And with the active ETF coming, I think that's a good example of how the line is being blurred.
Yeah.
So fully agree with what Sandro said. And I wanted to pick up on the last comment you made. I don't think that investors, especially retail investors, decided in favor of passive versus active. I think that chose ETF over mutual funds for a variety of reasons. I mean, if you buy products on digital platforms, in that case, ETF is simply the only wrapper, like the only product you can buy. And I think now that all of us have recognized that and are wrapping active strategies in ETF, I think those investors will now have a choice. If they want to choose that wrapper, they can buy active or passive. And I think that's also going to give a boost to active asset management.
So I just want to dive in as well to give, we're 13 minutes in now, just so people, to give them some advice, something for them to get their teeth in. You've given us some broad themes, investment themes, which are incredibly useful there, but to pull in some of those private markets that you talked about in that battleground for yield, across, of course, as you mentioned, fixed income, we've got alternatives, private credit, infrastructure, all the rest of it. Where are you all at? Maybe, Rajiv, I can start with that.
The quest for yield and private credit are the same topics, along with active versus passive. Active is not just stock picking or picking the right lender. It's about getting the right leverage. It's about getting the right term financing. It's about sourcing. It's about being there to see the opportunities before others see it. The key is, and so big picture, to answer your question, it's going to be a big theme because rates are coming down, inflation is coming down. How do you beat real and risk-free rates by 500, 600, 700 basis points? And that only way to do that, and that demand is not going anywhere, and it'll be substantial. Retail is doing a lot more active private investing in the US and other places now. 401ks are opening up. Most of the large asset managers' growth in assets is happening through retail, high net worth distribution. So the quest, and what the thought I'll leave you with, the quest for yield and private credit, which is the same thing, is to focus where it is not broadly syndicated. If something is broadly syndicated, well, then the borrower has more power than the lender. The borrower gets the terms they want to get, and you're not adding any alpha there. The alpha is when you source a private asset, a private loan, a private financing, where you do it bilaterally and you customize it in scale. And it can be done in scale against hard assets, where you define the terms, which is a win-win. If it's broadly syndicated, you decide what the spread is, what the covenants are, and there are 20 people competing to take that. So I believe a lot of lending is needed and will continue to happen against hard assets, against aircraft, ships, etc., etc. It's happening against data centers and so on, in hundreds of billions of assets. The key is not to participate in stuff which is auction, where you're just a marginal investor going in and begging, give me an allocation.
Alexander, compelling adjusted returns. Well, what's your call?
Look, there's an unsung hero in the fixed income markets who's been out of favor for, I think, 3 or 4 years, which is emerging market debt. Emerging market debt had strong performance in the last few years. If you look at the fundamentals, certainly versus developed markets, it has improved. So arguably developed markets have deteriorated, emerging markets have improved. If you look at central banks from emerging markets, they have post-COVID a better handle, having control of inflation. So I think there's a lot of factors that point to emerging market debt. You can pick up 3 points above developed markets. And I think it's a totally underallocated asset class overall. Whoever I talk to from our institutional client base, allocations are very small. Also in part because the supply of bonds in that category has been rather limited in the last few years, but supply is coming more. So maybe that's an area people could explore next to the private credit angle.
And Stefan, there's been a big chat all morning on stage about private credit, and we were just hearing about Blackstone saying, that's one of the things in the market that they believe people are misunderstanding. There was a big worry about how risky it was. So it's expanding. It's still relatively small. Are we still in a high growth phase? Is it something that you favor?
Yeah, and for a variety of reasons. So, when I joined the industry 25 years ago, I worked in Rajiv's broader area. And what he taught us back then is to break things down into very simple convictions you have to have. And I think for private credit, and I would include infrastructure debt, real estate debt. So it's not just lending to corporates, asset-based finance is obviously a key theme. I think, the two things which I think that asset class is going for itself is a massive supply-demand imbalance, where you have, in Europe, for example, many mid-cap corporates that require growth capital that banks simply don't supply. So there's scarcity of that sort of capital, which I think, people like us can provide. Similarly, in infrastructure. I mean, when you think about what Europe wants to do, there's going to be significant investments in infrastructure, so a massive demand for capital, which again, I don't think traditional banks can actually provide in that quantum. So just from that perspective, I think it's an asset class which offers very attractive, justified yield.
Sandro, something you're still focusing on as well, private credit?
Yeah, absolutely. And it's still, as we said, it's still a relatively small allocation with investors. And even within the overall mix of private assets, private credit is still relatively small. And there's a structural need to finance, especially in Europe, the growth in the economy. There's a significant imbalance at a moment in which banks are somewhat retreating. So there's a disintermediation element that will need to be fulfilled by asset manager. It's going to be interesting to see what will happen in the US, because probably some of the reforms will allow banks to do more in the US, and that might also create some reversal trend. But I completely agree with Rajiv. I think at the end of the day, scale now is what will make a difference, because it will give you access to deal sourcing completely different from being a small player. So selectivity is going to be key going forward, and the quality of and the concern. The overall concern is about the imbalance of supply demand, where you don't have enough deal to source, and that's where the selectivity comes into place. And the bigger you are, the more you're going to be in a position to set conditions, which is where you're going to create alpha.
So Rajiv, you've already given us some great insights into where your mind is in terms of how you're seeing the world. Is there any other points on private credit that you'd make, or indeed other emerging themes?
Well, private credit is a big space. As I said, I put it into two buckets. Yes, there is shortage of corporate bonds, but anything that's, you're getting paid illiquidity risk premium. So you better get paid enough for that illiquidity that you get, that you have. So in private credit, again, there is a lot of demand, and the demand will continue, is my prediction, as rates come down. Because if you look at the capital structure of a company, you have debt, you have equity. You take debt, which is at, say, 9%, you level it up once, you get to 15%. Is that the same risk-adjusted return as equity? Sometimes it's better. That 15 is better than making 15 in an equity situation where you don't have an exit in a private company, for example. I would rather take. So you have to do your analysis saying, where is my risk-adjusted return better? Being in the equity or being in the debt and levering it up where the risk is even lower than the equity? The key is to have long-term leverage so you don't get taken out at the wrong time when the markets drop. Have term financing. And if you can get 17, 18% return on a levered private credit situation, that to me is much more compelling sometimes than equity. So that's the analysis one has to do, because it's the same company with the same balance sheet. You're just taking senior liability, levering it up versus taking equity.
Now, we've got 5 minutes left, and I'll get in trouble if I don't get myself off stage on time. So that kind of leaves you just about a minute and a half each, or just under. AI technology, where is your mind at in terms of technology as a catalyst? Maybe start off with you, Alexander, first.
Look, I think technology is going to change fundamentally how we run asset management organizations. I mean, we are at the beginning really to deploy AI into the investment process. But if you think about the ability that we have to deliver better outcomes with our clients, leveraging big data, machine learning, I think for what we do, I think this could truly be transformational. And then you add to that all of what is happening in the last few years around digital assets. Maybe the next generation of investors will no longer have a custody account. They will invest through their digital wallets. So we need to be really fit and ready for the future to cater to what maybe is an analog world still, but we are slowly moving toward the digital world. Well, as I said, some investors, especially the up and coming, they invest differently. Stefan mentioned ETF as a wrapper, and they might want to hold all of their investments in a digital wallet.
Yeah. So, Stefan, sorry, I'm going to you just as you're having a quick drink. But which part's the most interesting to you?
I think both parts are very interesting for different reasons. I mean, on the digital assets, fully agree with what Alexander said. I think the financial plumbing that all of us got used to, where like 10 middlemen between investor and investment, is going to be disrupted. And I think once you represent ownership on blockchain, well, like that plumbing, again, is just going to revolutionize, and plenty of people will need to look for new things to do. AI is going to have a very different impact on our industry because, picking stocks and bonds based on publicly available information seems like a pretty obvious use case. Now, I think from speaking to smart peers here, I don't think anyone has really cracked it beyond efficiency gains, which I think you can get. What we experiment with is companions that try to take emotional bias out of your decision.
That suggests you're questioning valuations.
Say it one more
Perhaps.
time?
That suggests you're questioning valuations on some.
No, I mean, it's more, my point was specifically on asset management, that I don't think that people have found or haven't disclosed really creating alpha with that. Obviously, everyone is working towards it. But I think what people are using it for is making sure that if you have investment thesis, applying to the whole possible investment universe that you may not know yourself, definitely, correcting for emotional bias. But I think at some point we're going to be able to say, well, instead of saying what's the most likely, what AI is focused on, what is the one unconventional question that has not been asked yet? Almost the inverse of AI. And that's what we're experimenting with.
Okay. Do we have the answer yet?
Not yet, unfortunately.
Not
I'm working
yet,
towards
okay.
it.
Sandro, give me the last minute and then quickly Rajiv.
No, look, completely agree with Stefan. Everyone is experimenting, but the news of human investor being replaced by machine, I think, is greatly exaggerated at this stage. I think no one has found the code, and I think it will take a long period of time before we get there. I also think that the most potential impact on our industry are going to be the tokenized assets and the blockchain, because that will completely reshuffle the whole value chain in our industry. And this is the area where I think we're spending most of the time to make sure that we're ready for that.
I think that's going to be massive, and we're discussing that on this very stage here tomorrow. Rajiv, only 1 minute left.
Let me say this. The impact will be much quicker than people expect, what we are using it for. And I'll tell you where the impact is. It's in two places. Barriers to entry and scale benefits will erode.
That's true.
Because AI we are using for due diligence, for analysis, for portfolio maintenance and reporting. So an asset manager which says we have 2,000 employees and we have scale, you should give us your capital. That scale benefit is going to erode because 20 people with generative AI can produce the same output, can do the same due diligence, monitor the portfolio, monitor the debt and the equity and all that stuff, do a lot of investor relations, reporting. So scale benefit will definitely erode. An asset manager with 100 employees can do the same as maybe 500 employees.
Brilliant insights, gentlemen. Hit the clock on the button as well. What more could we ask? Thank you. A big round of applause for my panel here today. And thank you so much for those market insights. Very much appreciated. Thank you.